Let me bring in Dhirendra Kumar, the CEO of Value Research and our in-house mutual fund expert who joins us on the show. Dhirendra, this week I want to re-look at our aggressive portfolio. Now this is a portfolio designed for a 25-year-old, someone just starting up with a long career ahead of him, which means he has a long investment horizon. Now we began putting money in this portfolio in July 2009, 3 years ago. We hypothetically invest 10,000 rupees every month and we track its progress. The portfolio has given us an annualized return of 7% so far, which is not bad given the market we've seen over the last 2 years. Dhirendra, of course 7% is not a lot of returns for a portfolio that was meant to be aggressive, but are you happy with what you're seeing?
Yes, I was a little more optimistic than the kind of return it has generated, but we really don't have a control on that. I'm not disappointed at all. We are sitting on some gains. Our portfolio has been far more stable. On very few occasions we have been in red, that too for a couple of days. It is far less aggressive than I would like it to be. And this particular constraint is primarily because I would like this portfolio to be very tax efficient.
So in the attempt to make it a little more aggressive and bring down that allocation to large cap and to giant cap stocks, what changes would you propose right now?
What I have, in our first year we have these investment made into Reliance regular savings equity, the HDFC equity and ICICI Prudential Dynamic Fund. Those investments are good, but I would not like it to be part of this portfolio. That is why the investment into these funds stopped about a year back, and now all the gains are also tax free. Allocate all the realization from these three investments into our Quantum Long-Term Equity Fund, which is proving to be a very stodgy position in this one, and SBI Emerging Business, which I think is the truly aggressive fund which one can have today.
All right, SBI Emerging Business has in fact, since we began investing in it, given us 24% annualized return. We've been investing in that fund for a little over a year right now. Okay, so after those changes, this is what our aggressive portfolio looks like. Remember, it's designed for someone who's 25 years old who has a very high risk appetite. Now, DSP BlackRock Short Term has 10% in it. This is our debt component. IDFC Premier Equity Plan A 20%, Quantum Long Term Equity 25%, SBI Magnum Emerging Business 20%, and UTI Opportunities has 25%, and that's a total of 100%. We are hypothetically investing about 10,000 rupees every month in this portfolio to take a close look at it and see how it's doing, and we'll track it for you. We track it on a regular basis to tell you if you're following this portfolio, what changes you should be making. Alright, so that was our aggressive portfolio. Dhirendra, we have a question that's come in for you from in this segment. Satish has written in. He says he's invested in a couple of mutual funds with a time horizon of 25 years. Now, one of those mutual funds is the Fidelity Tax Advantage Fund. He has a couple of concerns. He invested in this fund until March 11, 2011. He's worried with the direct tax code introduced shortly. Will that investment still have its tax advantage? And also he's a little worried about what he should do considering Fidelity has booked out of this market and sold that business to L&T. Does it impact his investment in any way? Would you tell him that right now the direct tax code is not much of a concern?
Direct tax code is not much of a concern because you get the tax benefit. So if you had an earning of 5 lakh rupee, you made this 1 lakh rupee investment into the fund. For calculating taxes, your income was deemed as or considered as only 4 lakh rupees. And so you got the benefit in that year. Now the other benefit which you get in a tax saving fund, because it happens to be an equity fund, that the accumulation, the appreciation becomes tax free. Even in DTC, the appreciation, if for investment held for over 1 year, whether it be equity or equity fund, will be tax free. For all your investments which you make into tax saving funds till March 31st, 2013, it is all valid, and all the benefits accruing to you remains the same.
And we've been down this road before, Dhirendra, with the same question. Fidelity now becoming L&T. What does that mean for its investors? Is there reason for them to worry?
It's a reason for them to worry because investors bought the Fidelity story, and in this particular case, the tax saving fund, in case the fund manager goes away, goes back to Fidelity, a possibility which can't be ruled out. It is part of the deal. You don't have a choice but to stick with this tax saving fund because even in case of change of ownership, you will not have an interim exit route which you will have on a no-load basis in all other equity funds, because our tax laws don't allow that.
All right, Satish, keep a close eye on the fund manager of your fund and then decide whether or not you want to be moving out. Also, if you've invested in the tax advantage fund in 2011, you won't be able to pull that money out immediately. You'll have to wait for that 3-year lock-in to expire. Let's move on now to our hold or sell question. Govinda has written in Dhirendra, 36 years old, an income of 12 lakh rupees a year. He seems to have enough life insurance. He puts 15,000 rupees a month in mutual funds. He also has about 2,300 rupees going into his PPF account. He wants to save for his child's education and his own retirement. He has a long-term horizon. Are his investments on track? Now, on his list at 2,000 rupees a month, he has HDFC Balanced, HDFC Long-Term Advantage and HDFC Mid-Cap Opportunities. That suggests that it might be haphazardly put together. Does he need to have all three of those funds?
No, I don't think so. I think he can do without a balanced fund given his time frame and given his income level, and given that he's investing more money across other funds, so he can do without the balanced fund. He can also do without the long-term advantage fund. The HDFC long-term advantage fund is a tax-saving fund, so he may not be able to do anything about this position because it'll come with a 3-year lock-in period. So I would say that he should look at HDFC mid-cap opportunity, and that should be his only investment, and that it's a fairly aggressive and an impressive fund.
All right, after 3, you're only holding on to HDFC mid-cap opportunities. ICICI Prudential Focus Blue Chip Equity, Dhirendra, this is a strong fund, 2,000 rupees a month he's investing. Continue investing in the fund?
Yes, this fund has been very impressive. It had of course, it has a limited history, about 4 years. And past 6 months it has been little shaky. But I would say that he should hold on to this and continue his investment. It's still an impressive large cap fund.
ING Dividend Yield Fund at 1,000 rupees a month. It's a smaller allocation, but this is an impressive fund that you have mentioned on the show a couple of times.
Yes, it is a very impressive fund, and it has been impressive for a while now. And the fund portfolio is managed very methodically, and it remains like that over time. So one can hope that all the hygiene will be ensured despite the discontinuity of managers which we often see here. So this is another hold.
UTI MNC and UTI Opportunities together, Dhirendra, would you recommend he holds on to both of them?
No, he can do without the UTI MNC fund, because I think this, of course, this has been a very impressive fund. Because of a lot of delisting of the foreign companies or MNCs in India, the universe is getting narrower. It is not very diverse. So I think the reason why these funds came into being no longer exists. So I would say put all your money into UTI Opportunity Fund, an impressive fund. All
right, getting out of UTI MNC there. SBI Magnum Emerging Business, Dhirendra, continue investing in this fund?
Yes, given his time frame, I think HDFC Mid-Cap Opportunity and SBI Emerging Business. Of course, one has to keep an eye on these positions because these are aggressive funds. These are mid and small cap funds. They are very impressive right now, but they could be very taxing in lean times. So they require much closer monitoring. They are not the kind of fund which you invest and sleep over it and continue investing.
The last on his list is the Reliance Gold Savings Fund, Dhirendra. We've had a lot of talk about gold and where it's headed, but in your personal view, should he continue investing in this fund?
For most people, who ask this question, I normally tell them that think of it as you are buying gold in installment, which means you are making this investment, you are accumulating your savings, you are riding onto the gold prices, and at a future date, you will not realize the money for consumption. You are not looking at it as an investment. All
right, Govinda, that's the final verdict. You have that 2-year-old daughter that you are planning for. So use this gold fund really as sort of putting in money on an installment every month so that when you finally need that money for her, you can exchange it for actual gold for consumption. We hope that helped. Remember, there's an email ID at the bottom of your screen where you can send in your portfolio for Dhirendra to look at on this show. Dhirendra, one quick question before you leave. Neeraj is 37 years old. He's an NRI. He wants to invest 2 lakh rupees a month. He's just married, no other dependents other than his wife and no loans right now. He wants to know where he should start investing that money to build an investment portfolio.
Somebody starting early and investing 2 lakh rupees depends. He can choose our growth portfolio or our aggressive growth portfolio. I think aggressive growth portfolio, the way it is configured today, is fine for him. He can do without that fixed income allocation just in case he has other fixed income, because many people don't necessarily need this fixed income allocation in the kind of portfolio we are constructing, because you have some fixed income as an emergency fund or some mandatory investment going into it. So our aggressive fund or growth fund without the fixed income allocation.
Neeraj, our aggressive portfolio is on your screen right now. Good luck with that investment and get back in touch with us if you have any more questions. Remember, there's an email ID at the bottom of your screen. Write to us if you have a question for Dhirendra Kumar.